Welcome to the deep dive. Today, we're tackling a topic that's absolutely fundamental to understanding the real estate world,
Mm.
the economics that drive the market.
Yeah, you can think of these forces as kind of the engine under the hood,
Yeah,
the rhythm that really sets the pace for pretty much everything you do as an agent.
that's right. We're going to look at the core forces that influence property values, market trends, and ultimately every single transaction you might be involved in.
Exactly. It's about learning to read the market's heartbeat, really understanding the pulse behind the listings, behind the client conversations.
We've pulled together a pretty fascinating stack of sources for this deep dive. Everything from reports on how experts try, and I stress, try to forecast house prices, all the way down to the basic laws of supply and demand.
Plus, we'll dig into those broader market cycles and, of course, the heavy hitters, interest rates and inflation, big topics.
Huge. So our mission today is really to unpack these concepts and show you how these, seemingly abstract economic ideas are the actual drivers.
Right. They influence everything from what a home is worth to how quickly it might sell to whether a buyer can even, get the financing.
And understanding this makes you more than just someone who opens doors, right?
Absolutely. It makes you an informed strategic market advisor. So we'll be looking at insights from places like the Counselors of Real Estate, FCTEIS, Wikipedia, CAR, the California Association of Realtors CREXI, U.S. Bank, Outlier, Investopedia, and CrowdStreet. Let's dive in.
Okay, let's unpack this, starting with the absolute basics.
Yeah.
At its core, real estate, like any market really, is fundamentally governed by supply and demand.
It sounds simple, doesn't it? But the implications are just, well, profound. It really is the engine room.
So let's define those terms. Supply.
Okay, so supply. Our sources define it as the quantity of a commodity, in this case, houses that a producer or seller is willing and able to offer for sale at a given price over a certain time.
Right. So in real estate talk, that's the inventory, the number of properties actually listed, available for sale. It's what sellers are putting onto the market.
Exactly. Are there tons of homes for sale right now, or is it pretty slim pickings? That's your supply side.
And demand is the flip side.
It is. It's the quantity of that commodity homes that consumers or buyers are willing and able to buy at a given price over time.
So this is the pool of potential buyers, people who are actively looking, who want to buy, and crucially, can buy right now.
Right. The able part is key there. And what's absolutely crucial, and Investopedia lays this out really nicely, is the law of supply and demand.
Okay.
So first, the law of demand. It basically describes this inverse relationship between price and demand. As the price of something goes up, the quantity people demand generally falls.
Makes sense. People want less of something when it gets more expensive.
Pretty intuitive, right?
Uh-huh.
And conversely, as the price drops, demand tends to rise. Cheaper stuff, people want more of it.
Okay, that's demand. What about supply?
The law of supply works kind of the opposite way. As the price of something rises, the quantity that sellers are willing to supply tends to increase.
Because higher prices are a good incentive to sell. If home values are shooting up, more people think, hey, maybe now's the time to list.
Exactly. And if prices are falling, well, fewer potential sellers are encouraged, right? So supply might shrink.
To put them together, higher prices mean more sellers, fewer buyers.
Generally, yes. Higher prices encourage more supply but dampen demand, and lower prices. They encourage more buyers, so demand goes up, but they discourage sellers, so supply might drop.
So these two forces are always kind of pushing and pulling against each other.
Constantly. It's a continuous adjustment.
And where do they meet? Where's the balance point?
That's what Investopedia calls the market clearing price, or the equilibrium point. It's that theoretical spot where the quantity of home sellers want to sell roughly equals the quantity buyers want to buy.
The sweet spot.
In theory, yeah.
Yeah.
But here's the practical takeaway for you as an agent. The market is rarely perfectly balanced. It almost never sits right at equilibrium for long.
Okay, so what's the real world relevance then?
It's recognizing the imbalance. That's where the insight lies. If you're in a market, maybe a specific neighborhood, or even a certain price range where demand is way higher than supply, lots of eager buyers, very few homes listed, what does that tell you?
Prices are probably going up, seller's market.
Exactly. The laws of supply and demand predict that prices are likely to be pushed upward. That's a seller's market playing out right there.
And the opposite, lots of houses sitting, fewer buyers.
Supply exceeds demand. The prediction. Downward pressure on prices. It's becoming, or is, a buyer's market.
So understanding this basic relationship and really keeping an eye on the local balance of supply and demand is like the most powerful tool you have.
It absolutely is. For for advising clients on pricing, on strategy, on what to expect. It's ground zero.
Now, the sources also mention something called elasticity. Sounds a bit more complex.
It adds a layer of nuance, yeah.
Yeah.
FCT, EMIS, and Investopedia talk about price elasticity. It's basically the degree to which a change in price affects the quantity demanded or supplied. How sensitive is demand or supply to price changes?
Okay, give me an example.
Sure. Think about maybe your favorite brand of coffee. If the price doubles overnight, what do you do?
I'd probably switch brands or just drink less coffee.
Right. Your demand for that specific coffee is elastic. It reacts pretty sharply to the price change. But now, think about, say, life-saving medicine. If the price doubles,
You'd probably still have to buy it, right? Even if it's really hard.
exactly, demand for that medicine is likely inelastic. It doesn't change much even with a big price jump. People need it.
So where does housing fit in? People need shelter.
True. Basic shelter is a necessity, so there's some inelasticity there. But the demand for a specific house in a specific neighborhood at a specific price, that can actually be quite elastic.
How so?
Well, if prices in one neighborhood climb too high, buyers might react pretty strongly. They might start looking in the next town over, or maybe they decide to keep renting for another year, or they just pause their search altogether.
So they have options, or they can delay.
Right. And conversely, if prices drop noticeably in an area, you might see demand pick up quite a bit. So housing demand does respond to price, but it also responds, crucially, to other big things like buyer income, how easy it is to get a loan, and what people expect the market to do in the future. Things we'll get into more.
Okay, this makes sense. Let's try to apply this. Think like an agent. Imagine you've got two listings. They seem identical on paper, same size, same condition, similar neighborhoods maybe across town from each other. But listing A gets multiple offers, way over asking, practically overnight.
Wow, okay.
Listing B, though, just sits there, weeks go by, hardly any showings. Eventually, you have to talk to the seller about a price cut. How do the laws of supply and demand help you figure out what's going on at this, hyper-local level?
Great scenario. This is exactly where you apply the principle locally, not just generally. For listing A, the immediate conclusion has to be that the supply-demand balance in that specific micro-market, maybe that particular subdivision, that school district boundary, even that price point within the area is heavily skewed towards demand.
Way more buyers looking right there than homes available.
Exactly. It's a hyper-local seller's market.
Hmm.
There are far more buyers actively looking for homes just like that one, right there, than there are properties actually available to buy.
So your questions become really specific, right? Not just how's the market, but...
Right. You'd ask, how many other comparable homes are listed right now in this exact neighborhood? How many have sold recently? How fast did they sell? How many active buyers do I know, or do other agents I talk to know, who are specifically targeting this tiny area? You're trying to quantify that local imbalance.
Okay. And for listing B, the one that's just sitting there?
The conclusion points the other way. Supply likely exceeds demand in that specific micromarket at this moment.
Why might that be?
Could be several reasons. Maybe a few similar new listings just popped up nearby, suddenly increasing the local supply. Maybe a big local company just announced layoffs, chilling buyer confidence and decreasing demand in that area. Or maybe buyers in that specific neighborhood are just more price sensitive. Right now, their demand is more elastic there for some reason.
So for listing B, you're asking different questions.
Totally. Has inventory jumped up right here? Have recent sales in this immediate zone been slow? Or do they need price cuts to sell? Are there any, local factors impacting buyer traffic or maybe confidence just in this particular spot?
So it really underscores that supply and demand aren't just these big national concepts. They fluctuate block by block.
Absolutely vital to remember that. It's dynamic. Understanding that helps you price accurately and set the right strategy from day one. It's about reading the heartbeat of that specific little market pocket.
Okay, so moving beyond the immediate forces of supply and demand for a single transaction, the market as a whole doesn't just sit still, does it? It moves in these broader rhythms.
That's right. It's influenced by the overall health of the economy. And this is where we start talking about cycles, business cycles, and real estate cycles.
Let's start with business cycles. Our sources, like Wikipedia, define these as intervals of general economic expansion followed by a recession.
Right. These are big, widespread shifts in economic activity. They affect things like income levels, employment rates, how much stuff companies are producing, how much people are buying in stores. Basically, all the stuff that impacts people's ability and confidence to make huge financial decisions, like buying a house.
And how is a recession actually defined? I feel like I hear different things.
Yeah, there are a couple of common definitions. The sort of quick rule of thumb you often hear is 2 consecutive quarters, so 6 months of negative GDP growth. The economy shrinks for 2 quarters in a row.
Okay.
But Wikipedia notes the more comprehensive definition used by the experts at the NBER, the National Bureau of Economic Research. They look for a significant decline in activity spread across the economy, hitting things like real income, employment, industrial production, retail sales, and, importantly, lasting more than just a few months. It's a broader, deeper kind of slowdown.
It's also interesting, Wikipedia mentions that mainstream economic thinking doesn't always see these cycles as perfectly predictable, like clockwork.
That's a really important point. Some views, drawing on work by economists like Slutsky, suggest that what we perceive as cycles might actually be the result of lots of different random economic shocks, good ones and bad ones, kind of accumulating and averaging out over time.
Which explains why predicting the exact timing of when the market's going to turn is, well, really hard.
Notoriously difficult, yes, which we'll come back to.
So how do these big economic rhythms translate into the real estate market specifically?
Well, the CrowdStreet source focuses on commercial real estate, but it outlines a pattern of cycles that applies conceptually to residential too. The real estate market tends to move through distinct phases that are linked to that broader economic rhythm.
Okay, let's walk through those 4 phases they describe. And we should keep in mind, even though they talk about commercial strategies, the underlying dynamics, supply, demand, vacancy rates, price trends, those are universal, right?
Absolutely. So phase one is recovery. This often comes after a recession. The key feature is that supply still outweighs demand.
So lots of properties available, not as many takers.
Exactly. In commercial, that means high vacancy rates. In residential, you'd see high inventory, maybe homes sitting on the market longer. Rent growth or price growth during recovery is usually pretty slow, often lagging behind the overall rate of inflation. It's a time when you might find undervalued or distressed properties.
Okay, that's recovery. What comes next?
Phase two is expansion. The general economy is picking up steam, jobs are being created, people feel more confident. In this phase, demand starts to catch up with supply, and often it begins to exceed it.
So vacancies fall in commercial and in residential.
Inventory shrinks. Homes start selling faster. Rent and price growth accelerates, often rising faster than the general inflation rate. This is the phase where building new properties looks really attractive because demand is so strong.
Bidding wars become more common here.
Very typical of the expansion phase in residential, yes.
Okay, recovery, expansion. What's phase 3?
Phase three is sometimes called hypersupply. Think about it. Developers were busy building during the expansion phase because things looked great. Now, all that new supply starts hitting the market, often faster than demand is still growing.
Ah, so supply starts to outpace demand again?
Exactly. Vacancies begin to tick back up, rent or price growth starts to slow down, maybe flatten out, the market is getting a bit saturated.
For residential, this might look like inventory starting to creep up again. Homes taking a little longer to sell than they were.
That's the kind of signal you'd look for, yes. The peak enthusiasm might be fading.
And that leads to phase 4.
Phase four is recession. Here, the broader economy contracts, maybe significantly. Job losses, less income, less confidence. This leads to decreased demand for real estate.
So now supply significantly outweighs demand again.
Right. Vacancies jump up. Rent or price growth might turn negative, or at least be severely squeezed. You might see more concessions from landlords or sellers.
This sounds a bit like the recovery phase again, but driven by economic decline.
That's a good way to think about it. The supply-demand balance looks similar, but the driver is economic contraction rather than just slow growth after a prior downturn. In residential, you'd expect inventory to spike, maybe prices falling, and an increase in distressed sales like foreclosures.
So understanding which phase the market generally feels like it's in recovery, expansion, hypersupply, recession that helps you advise clients.
Hugely important. It's about managing expectations and identifying potential opportunities or risks. Are we in a recovery phase where buyers might find good value? Or expansion, where it's a great time for sellers to list but buyers face competition? Hypersupply, where sellers need to be realistic and buyers might gain some negotiating power. Or recession, which presents challenges but also potential opportunities for those positioned to buy distressed assets.
But like you said, predicting the turns is tough.
Very difficult. The Counselors of Real Estate source really emphasizes that. Forecasting these cycles, especially nailing the exact turning points, is a constant challenge. They mention early work by Case and Schiller showing that real estate markets aren't always efficient in the economic sense, Prices can show momentum, trending in the same direction for years, making it hard to call the top or bottom.
Are there methods people use to try and forecast?
Oh yeah, the sources mentioned various methods, especially for national or regional forecasts, things like time series modeling, looking at past patterns, autoregressive models. Some try recursive forecasts, constantly updating them with new data to improve timing.
But what about locally? For my city or county?
That's the rub. The counselors of real estate point out there's generally less focus and, frankly, less reliable long-term data available for forecasting at these really granular subnational levels, the state, metro, county, let alone neighborhood level.
Even though that's where housing markets actually function, people buy in a specific town, not nationally.
Precisely. So, while understanding the big national picture and the general cycle phase provides crucial context, you absolutely have to drill down and analyze the specific data available for your local market. What's happening in, say, San Diego might be quite different from Sacramento at any given moment, even if the same underlying economic principles apply. Local analysis is key.
Okay, so beyond the basics of supply demand and these broader cycles, there are two huge economic forces that really seem to dominate the headlines and impact real estate: interest rates and inflation.
Absolutely massive influences, and they're deeply interconnected. They don't just make headlines. They directly hit people's wallets and change market behavior.
Let's start with interest rates. Their biggest impact is on affordability, right?
Squarely on affordability. The U.S. bank source makes this incredibly clear. When interest rates go up, the monthly mortgage payment for the exact same loan amount goes up too, sometimes significantly.
Which means buyers can afford less house for the same monthly payment.
Or they need a higher income to qualify for the same house. It directly shrinks their purchasing power. U.S. Bank even gave a specific number. They mentioned a median monthly mortgage payment projection for May 2025, around $2,860. And they described that as only modestly below the all-time high, adding that the prospects for a big improvement in affordability weren't looking favorable.
Wow, so just a couple of percentage points difference in the mortgage rate.
It can change the monthly payment by hundreds, sometimes thousands of dollars, depending on the loan size. That difference can easily be enough to make a particular property unaffordable for a buyer, or force them to look at much cheaper homes, or even push them out of the market entirely for a while.
And that obviously impacts overall market activity.
Inevitably. Higher rates price some buyers out. Others might just decide to pause their search, maybe wait and see if rates come back down. This shrinks the pool of active buyers, which naturally dampens demand.
Does this affect commercial real estate too?
Yes, the Crixie report mentioned this. Things like delayed interest rate cuts can make businesses postpone investment decisions, expansion plans, which impacts demand for commercial space. It's a broad effect.
No, CIR's forecast mentioned something specific about interest rates and supply. The lock-in effect.
Yes, this is a really significant factor, especially in recent years. The California Association of Realtors, in their 2025 forecast, specifically said they expect a more favorable interest rate environment to help loosen up the lock-in effect.
What exactly is that effect?
Think about all the homeowners who bought or, importantly, refinanced their homes back when mortgage rates were historically low, maybe in the 3% or even 2% range.
Yeah, a lot of people did that.
Right. Now, fast forward. If current rates are, say, 6% or 7% or higher, that homeowner is really hesitant to sell their current home, right? Because selling means giving up that incredibly low mortgage rate.
And they'd have to take out a new mortgage on their next home at the current much higher rate.
Exactly. So even if they buy a similarly priced home, or maybe even downsize slightly, their monthly mortgage payment could jump dramatically just because of the higher interest rate on the new loan.
So they feel locked into their current home by their low rate.
Precisely. This hesitation by huge numbers of potential sellers directly limits the supply of existing homes coming onto the market. It constricts inventory, making the market tighter than it otherwise would be, even if buyer demand isn't necessarily booming.
Wow. So interest rates hit demand through affordability, and they also hit supply through this lock-in effect. That's powerful.
It's a major dynamic influencing the market right now. It really highlights how interconnected everything is.
Okay, a quick aside on rates. Wikipedia mentioned something about the yield curve predicting recessions.
Ah, yeah, the yield curve. It's basically the difference between short-term interest rates, like on Treasury bills, and long-term interest rates, like on Treasury bonds. Wikipedia notes that its slope is considered a pretty powerful predictor of future economic growth, inflation, and potential recessions.
How does that work?
Well, typically long-term rates are higher than short-term rates. But when the curve inverts, meaning short-term rates become higher than long-term rates. That's historically been a fairly reliable signal that an economic slowdown or recession might be coming within the next year or two.
Why that?
It suggests that investors expect rates to fall in the future, possibly because they anticipate weaker economic growth and lower inflation, maybe prompting the central bank to cut rates down the line. It's not a perfect predictor, but it's something economists and the Fed watch very closely. It ties back into those business cycles we discussed.
Fascinating. Okay, let's switch to the other big hitter, inflation.
Right, inflation. Wikipedia defines it as a general rise in a broad price index, basically. The overall price level for goods and services across the whole economy is going up.
It's really important to distinguish this from appreciation, right?
Absolutely crucial distinction. Inflation means your dollar buys less stuff, less gas, less groceries, less everything. Your purchasing power is eroding. Appreciation, on the other hand, is when the value of a specific asset, like your house, goes up. They're related, but different concepts.
What causes inflation generally?
Wikipedia points to a few key drivers. You can have demand shocks, maybe sudden increases in demand, perhaps fueled by government spending or very easy monetary policy. You can have supply shocks, things like oil crises or major disruptions to supply chains that make goods scarcer and more expensive.
Like we saw recently with certain goods.
Exactly. And then there's the role of inflation expectations. If businesses and consumers expect prices to keep rising rapidly, they might change their behavior. Businesses might raise prices preemptively, workers might demand higher wages, and those expectations can become self-fulfilling, pushing inflation higher.
And interestingly, housing costs themselves are often mentioned as a big driver of inflation.
Yes. The cost of shelter, both rents and imputed rent for homeowners, is a major component of the inflation indices like the CPI. So rising housing costs can significantly contribute to the overall inflation rate that central banks are trying to manage. It could be a bit of a feedback loop sometimes.
How do they measure inflation? Is it just one number?
Not quite. There are several key indices. The most well-known is the CPI, the Consumer Price Index, which tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services.
Okay.
There's also the PPI, the Producer Price Index, which measures price changes from the perspective of the seller-producers of goods and services. Sometimes changes in the PPI can show up later in the CPI, so it could be a bit of a leading indicator.
I've also heard of core inflation.
Right. Core inflation typically excludes the volatile food and energy prices from the index. Central banks often pay close attention to core inflation because they feel it gives a better sense of the underlying, more persistent inflation trend, stripping out the temporary spikes or dips from things like gas prices.
What are the effects of inflation? Is it always bad?
Well, high inflation generally has negative effects. It creates uncertainty, which can discourage businesses from investing and people from saving long term. It erodes the value of savings and fixed incomes. In extreme cases, you get hyperinflation, which can totally destabilize an economy.
But are there any potential positives?
Some economists argue that a low, stable, moderate level of inflation might have some benefits. For example, it might help labor markets adjust more smoothly, or it gives the central bank more room to lower interest rates in a downturn before hitting zero, avoiding what's called the liquidity trap. But generally, high and volatile inflation is seen as damaging. For the average person, the most direct hit is just that loss of purchasing power.
And this brings us back to interest rates, doesn't it? Central banks use interest rates to fight inflation.
That's the primary tool, yes. Central banks like the U.S. Federal Reserve typically have an inflation target, often around 2%. As Wikipedia notes, if inflation is running too high, well above the target, they will usually raise interest rates.
Why does raising rates help?
Higher interest rates make borrowing more expensive for consumers and businesses. That tends to slow down spending and investment, which cools off overall economic activity, aggregate demand. Less demand pressure generally leads to slower price increases, bringing inflation down.
And if inflation is too low or the economy is weak?
They might lower interest rates to make borrowing cheaper, encourage spending and investment, stimulate the economy, and hopefully push inflation back up towards the target.
So there's this constant adjustment based on inflation readings.
Exactly. It works through various channels affecting borrowing costs, asset prices, exchange rates, which eventually influence aggregate demand, employment, wages, and ultimately prices and inflation itself. There's this concept called the Phillips curve, which historically suggested a trade-off between unemployment and inflation, although that relationship has become more complex over time.
Okay, let's connect all this back for the agent listening. Understanding this link, how the Fed uses interest rates to manage inflation, and how both of those directly hammer affordability, purchasing power, market psychology, and even inventory through that lock-in effect. This is critical, isn't it?
Absolutely critical.
Yeah.
This isn't just abstract economics you read about. This is the stuff that directly impacts whether your client can get a loan, how much house they can afford, whether they feel confident enough to buy or sell, and even how many houses are available for them to look at.
So this brings us to that adapt and connect idea. Knowing this helps you adapt your advice.
Precisely. When a client asks you, why are mortgage rates so high? Or why is the market acting so weird? Quote, you can actually explain the underlying economic context. You can say, well, the Fed is raising rates to combat inflation, and here's how that affects mortgage costs.
And here's how it's making some sellers hesitant because of the lock-in effect, which is keeping inventory tight.
Exactly. Explaining the why builds incredible trust. It positions you not just as someone showing houses, but as a knowledgeable advisor who understands the bigger forces shaping the market. It helps clients make decisions based on insight, not just anxiety or guesswork.
Okay, let's make this even more concrete. Let's zoom in on the Golden State with some specific California market data. We've got the CAR forecast for 2025 right here.
Yes, the California Association of Realtors provides these forecasts based on their analysis of exactly these economic drivers we've been discussing. So what are they seeing for next year?
For existing single-family home sales in California, they're forecasting 304,400 units in 2025. Now, that's projected to be a pretty healthy jump, 10.5% from their 2024 projection of 275,400 units.
And that 2024 number was already up from 2023's actual sales of about 258,000. So they're expecting the pace of transactions, the number of sales, to pick up quite a bit next year.
Okay, what about prices? Still going up.
Looks like it. The median home price in California is forecast to increase by 4.6% in 2025, reaching $909,400.
Almost $910,000 median price. Wow. How does that compare to the year before?
Well, that 4.6% rise follows a projected increase of 6.8% in 2024, hitting $869,500, which is up from $814,000 in 2023. So the forecast suggests prices will continue to climb, maybe just at a slightly slower rate of increase than the previous year's projection, but still a significant jump in dollar terms.
And affordability, does that get any better with more sales?
Not according to CAR's forecast. They expect housing affordability to basically remain flat, hovering around 16% in 2025. That's the same as the projection for 2024, which was actually a slight dip from 17% in 2023.
Just pause on that. 16% affordability means only 16%. About 1 in 6 California households can actually afford the median-priced home based on typical incomes and mortgage rates.
That's right. So even if the rate of price increase slows a bit, the fundamental affordability challenge in California remains incredibly persistent.
What factors did CAR cite for this forecast? What's driving these numbers?
It directly echoes our conversation. They point to expectations of a more favorable interest rate environment, meaning they anticipate rates might ease slightly.
Which would help loosen that lock-in effect we talked about.
Exactly. They expect it to encourage both buyers, better affordability, and sellers, less painful to give up their old rate, to come back into the market. They also mention inventory improving slightly, but still being low relative to demand due to the persistent long-term housing shortage here in California.
And that shortage keeps the market competitive.
Right. Even with slightly better inventory, the underlying lack of housing means competition remains, which continues to put upward pressure on prices. It's a perfect illustration of all these forces, rates, supply, demand interacting.
It's good to see how these concepts play out in actual forecasts. And just for context, that Crexi report showed how different things can look in commercial real estate, or even just different parts of the state, right?
Absolutely. The Q1 2024 Crexi data showed, for example, Los Angeles having the highest average industrial price and office asking price among the markets they listed then. But San Diego had the highest average industrial rent. Las Vegas led in office cap rates. Atlanta had highest average office asking rent.
So huge variations depending on property type and location.
Huge. But the key takeaway is that the underlying economic principles, supply, demand, the cost of borrowing via interest rates, the impact of the broader economy, those are the forces driving the numbers in all these different market segments and locations, even if the outcomes look different. Crexie also mentioned broader economic uncertainty and those delayed rate cuts impacting investment, reinforcing our themes.
So the CAR forecast really pulls it together: interest rates influencing volume and the lock-in effect, the housing shortage impacting prices via supply demand, and buyer competition resulting.
Exactly. And looking slightly further ahead, that U.S. bank source threw in a note of caution about future supply from new construction.
Oh yeah, what was the concern?
They mentioned that prospects for building new homes could be clouded by potentially higher material costs, maybe due to things like tariffs, and also potential challenges with workforce availability, perhaps linked to immigration policies. Anything that makes building harder or more expensive could impact how much new supply actually comes online to ease the shortage.
That's a really important long-term factor, and we also shouldn't forget that point from Outlier about just consumer psychology.
Right, expectations matter. If buyers and sellers feel pessimistic about the economy or the future of the housing market, that sentiment itself can change demand. People might delay buying, hoping for lower prices, or sellers might rush to list before things potentially cool off. Confidence, or lack thereof, is its own economic force.
Okay, this feels like a good moment to bring in the ethical compass. We've talked about how complex all this is, how hard forecasting is, especially locally. Given all that uncertainty and complexity, what's the ethical responsibility of an agent armed with this economic knowledge?
It's a huge question and incredibly important. The core ethical responsibility is honesty about that uncertainty. You cannot ethically present yourself as some kind of market guru who knows exactly what prices will do next month or next year.
No crystal balls allowed.
Absolutely not. You can't guarantee outcomes, so your role has to shift. You're not a predictor. You're an informed guide.
So use the knowledge not to make promises, but to explain.
Precisely. You leverage this understanding of supply and demand, of market cycles, of how interest rates and inflation work, of what forecasts like CARs are saying, and why you use all that to help your clients understand the forces shaping the market right now. You explain the potential influences, the risks, the opportunities based on the data and the economic principles.
And you have to be honest about the limitations, especially with local forecasting.
Completely. You say, here's what the statewide forecast suggests, but our local market might behave differently, and here's the data we do have for our area. Then, crucially, you help them relate all that market context back to their own unique situation.
Their finances, their goals, their timeline, their tolerance for risk.
Exactly. Your job is to provide the economic lens, interpret the available data, and empower them to weigh the factors and make their own informed decision that aligns with their personal circumstances. It's guidance, not guarantees. That's the bedrock of ethical practice here.
Let's really nail this down. Think like an agent, but with this ethical hat firmly on. Your client looks you in the eye and asks that direct question. Okay, bottom line, is right now a good time for me to buy? Or maybe a good time for me to sell? How do you answer that, knowing everything we've just discussed, the cycles, the rates, the lock-in, inflation, the CAR forecast showing rising prices but tough affordability, the forecasting challenges? What's the structure of that conversation?
Great question to roleplay. First, you absolutely do not give a simple yes or no. That would be irresponsible. You start by acknowledging the question and framing the discussion correctly. Something like,
That's the million-dollar question, isn't it? And honestly, the right time really depends more on your individual situation and goals than just the market itself. But let's walk through the key market factors we're seeing right now based on the latest data and forecasts so you can see how they might relate to your plans.
perfect start. Then you start weaving in the concepts conversationally. You might bring in the CAR forecast. So the statewide forecast from the Realtors Association suggests they expect prices to keep increasing into next year, maybe around 4 or 5%. They also see sales activity picking up, which could mean more homes to choose from, but also shows demand is expected to remain pretty strong, partly because we still have that long-term housing shortage here.
Then pivot to rates and affordability.
Exactly. Now, a huge piece of the puzzle is interest rates. Right now, they're hovering around X%. We know that directly impacts your monthly payment and overall affordability. It's tough out there for buyers. That rate is also contributing to the lock-in effect, where some homeowners with older, super low rates are hesitant to sell, which keeps inventory tight.
Maybe mention the outlook for rates.
You could add, some forecasts like CARs hope rates might ease a little next year, which could help loosen things up a bit. But nobody's expecting a dramatic drop back to where they were. So affordability is likely to remain a major challenge.
Then connect it to the broader cycle.
Yeah, briefly. And zooming out, the economy is still dealing with inflation and the effects of these higher rates. It's hard to pinpoint exactly where we are in the cycle locally, but we can look at indicators right here in our neighborhood, like how many days homes are staying on the market, how much inventory we have compared to last year, to get a feel for the current supply and demand balance right here.
Maybe a quick mention of inflation's role.
You could touch on it. And of course, general inflation affects everyone's budget. Historically, owning real estate has sometimes been seen as a way to hedge against inflation over the long term as the asset potentially appreciates. But obviously, there are no guarantees, especially in the short term.
And then the crucial pivot back to the client.
This is key.
Yeah.
You bring it all together and turn it back to them. So considering all these factors, the outlook for prices, the current reality of interest rates and affordability, the inventory situation, the broader economic climate, the real question becomes, how does this align with your personal situation and goals? What are you hoping to achieve? How long do you plan to stay? How comfortable do you feel with the potential monthly payments right now? How stable is your job and income? What are your other options if you wait?
You're empowering them.
Exactly. You finish by saying something like, my role here isn't to tell you when to buy or sell, but to give you the best possible understanding of the market context and the economic forces at play so you can weigh everything and make the decision that feels right and makes sense for you based on your readiness and what you want to accomplish.
That is a world away from just saying, yeah, it's a great time, or no, you should wait. It's professional, ethical, and truly advisory.
That's the goal. Informed guidance, not flawed prediction.
Okay, let's do a quick flyby recap of the most crucial takeaways from this deep dive into real estate economics.
All right, number one, those fundamental laws of supply and demand, they are the basic engine, price and quantity. Recognizing the imbalance between them, especially locally, is your key to understanding immediate price pressures.
Number two, real estate moves in cycles, mirroring the broader economy. Understanding the phases, recovery, expansion, hypersupply, recession gives you a strategic framework, even though forecasting the turns precisely is really, really hard, particularly for your local patch.
Number three, interest rates. They hit affordability hard, they influence market activity levels, and they have that powerful lock-in effect on supply right now. And things like the yield curve can offer clues about where the broader economy might be headed.
Number four, inflation. That general rise in prices erodes purchasing power. It's also a primary target for central bank policy, meaning the Fed's actions on interest rates to fight inflation have direct, significant consequences for the housing market. It's all connected.
Then we brought it home to California. We looked at the CAR 2025 forecast, expecting continued price growth, more sales, but persistent affordability issues, all driven by that interplay of rates, supply constraints, including lock-in, and ongoing demand.
So the big takeaway, learning to read this economic heartbeat, understanding these drivers, lets you step up from being just a salesperson to being a genuinely informed, strategic, and adaptable advisor for your clients here in California.
Nicely put. And that really wraps up our deep dive into the economic side of things. Next time, we're going to pivot completely and start laying down the legal foundations.
Right. We'll begin exploring those core legal concepts that govern property ownership in California. Things like different types of estates and land, property interests, ownership rights, the legal skeleton that holds every transaction together.
It's essential stuff. Looking forward to it.
Me too. Thank you all for joining us for this deep dive today.
Yeah, we really hope this exploration of real estate economics has given you a clearer, more practical picture of the powerful forces shaping the market you work in every single day.
Keep these concepts in mind. Maybe try explaining supply and demand or the lock-in effect to a friend or colleague. Just practicing articulating it helps cement your understanding. The better you get that heartbeat, the better you can serve your clients.
And definitely revisit those think like an agent scenarios in your head. How would a sudden rate drop affect your buyers? How would rising inventory impact your sellers? How would you use these economic principles to guide them through those specific situations? Practice applying it.
Absolutely. Remember to subscribe if you haven't already, and please share this deep dive with anyone else you know who's navigating the California real estate world or thinking about jumping in.
And maybe chew on this final thought. We've hammered home how difficult forecasting house prices is, especially locally. Given that inherent uncertainty, how much weight should you, as an agent and your clients, really put on trying to perfectly time the market based on predictions? Versus perhaps focusing more intensely on understanding the current economic forces at play right now, and how those forces intersect with the client's own concrete goals, financial readiness, and personal timeline. Where should the real focus be? Something to ponder.